Welcome everyone to the monthly con call on where things stand with respect to the economy, with respect to the markets. So today we'll cover a lot about what's happening in the world and in India with the Trump presidency now having established itself. There are quite a few developments on the tariffs front, etc. We did a podcast on that again about 3 weeks back. We sent it across. We also been writing on it on our blog. But in this call, we'll again go through some of those points. We'll also definitely cover what's happening with respect to the market and valuations, etc., and what are the implications and what is the outlook for us as investors. We have seen some impact on the portfolios, but then again, the last 10 sessions, the market has seen a decent recovery. So we are monitoring some of those. Yesterday, we sent an email on the where the market is likely headed. So we plan to do that on a weekly basis in terms of uh, the market action, etc. We don't do technicals as such, but it's a good place to recap how the market has done. And yeah, and then we'll take any questions again as usual on the chat mode. We'll also go through the emails to see if any questions have come. So without much further ado, I will pass it on to Manoj, who will, as usual, take the masterclass on the economy and the markets.
Good morning, everyone. I'm not sure if this is going to be a master class, but nevertheless, we'll share our views. There's so much of news that is going around, and a lot of experts providing their opinions. So not sure if we can add anything new, and even if we add something, not sure whether it will stay relevant for the next few days, given the dynamic situation. But nevertheless, we'll make an attempt. And we thought this time, let's take a step back and look at the whole thing little conceptually. So we will probably give you some insights. Of course, we'll get into macros, current situation, what to expect, etc. But let's say if we can have some context around it. Now, those who have been attending our calls will agree that we have repeatedly said that market direction is driven by liquidity. Now, in simple terms, liquidity is the amount of money in the market. If there's a lot of money going after any particular asset, then that asset will become pricey or expensive. If a lot of money is exiting that asset, then we will see that the asset price will go down. Now, liquidity or the flow of money is impacted by two things. First, and the most obvious, is the prospect of gain. Now, you put your hard-earned money on something that you expect will go up so that your wealth increases. So, a simple statement would be money chases returns. So, where you see returns, money will go in that direction. In other words, liquidity will flow in that direction. Now, our expectation of returns is to some extent guided by valuations. Now, of course, we have mentioned many times that valuations are very subjective. And if there's a lot of money in the market, everything looks very cheap. And if there's not much money in hand, then everything looks expensive. So to some extent, this becomes a cycle. Valuations depend on liquidity. Liquidity is a factor of expected gains, which is influenced by valuations. So this cycle is broken by the second factor that impacts liquidity, which is uncertainty or clarity, if you will. Wherever there is uncertainty, one does not know what to do. And therefore, the choice of action is inaction, not to do anything. We are not sure of the prospect of gain, so we simply tend to play safe till the uncertainty ends. And as a result, liquidity dries up. Another aspect that we would be considering or will factoring in is what we call as the theory of expectations. Now, what is theory of expectations? It is whether the actual result is better or worse than what we expected. If an event occurs, whether an RBI monetary policy declaration or whatever, budget declaration or anything, if we are expecting something and the actual event is better than that, then we actually rejoice. So the event in itself may be good or bad, but more than that, what is expected out of that event and the actual in relation to that event becomes more important. And we will see this theory playing out many times. Now, keeping this conceptual framework in mind, let us now look at some data points and then try and see if we can gain some insights. Now, our practice is usually we do a global roundup, we look at how things are happening all over the world. This time, we will probably restrict that to the US because there's a lot of action happening there. India, and to some extent, our friendly neighborhood, China. So let's begin with the US. The big disruptor ever since President Trump took over, the White House has been full of uncertainty. You really do not know what is going to come next. The man is in a hurry to make America great again and has been literally making the world sway to his fancies. As Ram mentioned, we have already done a podcast discussing what we call as Trump tariff tantrums, and I obviously do not wish to repeat the same, but the key issue there and our message there is that an increase in tariffs need not necessarily benefit America. Okay. US is not in a position to simply dictate terms and the rest of the world will follow with folded hands. There will obviously be a trade war. Now, this could just be a negotiating tactic, because what Trump is saying is, if you don't reduce tariffs, I will increase tariffs, reciprocal basis. So many countries might want to accommodate Trump and reduce the tariffs, as a result of which the US products will have greater access to their markets. Or countries may retaliate, particularly given the tone in which these tariff tantrums are being made. Countries may retaliate and then there are no winners. And as a result, the US might see heightened inflation, lower growth, and higher interest rates. And this is what economists call stagflation. Okay. So stagflation is worse than inflation. Stagflation is, as I mentioned, inflation without growth. The latest numbers that have come from the US during the latest monetary policy announcement should at least raise some concern. Now, GDP growth rate is said to be lower. Inflation is projected upwards, and unemployment is also expected to inch up. And this is the precise mix of what I just now explained as stagflation. Now, this should have resulted in markets actually falling. No, it's bad news. But markets actually cheered the quote-unquote dovish stance of Fed, clinging on to hopes of those two more interest rate cuts in the year. Now, probably given the scenario, markets were not expecting that. Markets were thinking that there will be a rollback. Interest rates might not come down. But the Fed chairperson discounted that and said that we are on track to have two more rate cuts, and that led to the US markets and again Indian markets, etc. going up. Now, contrast this to the situation in India. annual GDP growth rate has rebounded to 6.2% in Q3, vis-a-vis 5.6% in Q2, reversing a falling GDP trend since Q4 of last year. So for last 3 quarters, we've been having a falling GDP number. This time we've done a turnaround. India continues to be the fastest growing economy. Our core inflation is towards the lower end of RBI's band at 3.61%. Current account deficit has improved to 1.2% of GDP against 2% in previous quarter. Tax collections are buoyant. And whatever be your spiritual inclination, economically, Mahakumbh has been hugely successful, and that would significantly add to the GDP growth rate for Q4. Therefore, on the macro front, India is looking quite good. Given Fed's optimism of 2 more rate cuts in the year, it opens up the possibility of further rate cuts in India. Now, what has Fed's rate got to do with India's interest rate policy? It is important for RBI to factor in interest rates in the US. If interest rates in US remain high, RBI cannot afford to cut interest rates here. Let us understand this so that everybody is on the same page. So let us say there's an American investor who has got $100, and for simplicity's sake, let's say he or she can earn 5% returns in the US. In India, let's say interest rates are at 10%. So the investor sees higher returns and decides to invest in India. And again, for simplicity's sake, let's say the USD INR rate is 100. So the 100 USD gets converted into 10,000 rupees, gets invested at 10% for 1 year, and becomes 11,000 in 1 year. But during this period, the USD INR rate has, let's say, gone up to 105. I've just taken the 5% annual depreciation in rupee. So the 11,000 rupees, when converted back to USD, becomes only $104.76, earning a return of 4.76%, which is less than the 5% in US. So the investor would say, I'm better off investing in the US rather than put money in India. And that probably explains to us the dilemma of RBI. If interest rates in India are lower, then the flow of capital from US to India is unlikely to happen. There will be a lot of concern. And therefore, the interest rates will have to be kept. But the probability of lower interest rates in US in future helps RBI to take that call, because our other macro parameters look in much better shape and in control. So if the Fed has said that we may not be cutting interest rates going forward, then we can expect better rates or lower rates in India. Had the Fed not given that dovish statement, probably we wouldn't have seen the markets rejoicing the way they did. Okay. Now, a lot will depend on what will happen on April 2nd. Trump's higher tariffs are likely to kick in on 2nd. Now, as I said, there will be some countries who will agree to cut tariffs. There will be some countries who will have retaliatory tariffs. And the stance of the various countries will depend on what is the export-import basket vis-a-vis US. In respect of India, as Trump has pointed out, Indian tariffs are quite high on a very large number of products. So our government is, instead of making some big statements, quietly trying to work with the US to get a win-win solution. So we have to be mentally prepared that there will be some cut in tariffs, maybe on automobiles, defense items, energy, etc. There are some 30 items which we have listed down as areas where we will probably kick in lower tariffs. There will be some for which the government will not agree. For example, agricultural products. So depending on what is agreed between the two governments, some industries and therefore some companies will get impacted. So as things stand today, what we have is uncertainty. And it is up to our business leaders to anticipate and come up with appropriate solutions to counter the worst case scenarios. Now, Trump is coming up with unilateral decisions almost every day. Some of these will encounter challenges in implementation, because the clarity is not there. It is not a well thought out policy announcement. It is simply going ahead and announcing something, and the nitty gritties have to be worked out. So this will keep everyone on tenterhooks. Given the speed with which Trump is making announcements, most likely he will exhaust all his ideas in 6 months. Whatever is coming into his mind, he is announcing, and then everybody is running helter-skelter. So some of these ideas will succeed, some of these ideas will fall. And this period will be very volatile. But it is our call, based on our understanding of whatever are the macro scenarios and the major trade partners of US, etc., that this period or at the end of this period of volatility, we are not going to see a dramatic shift. After all the noise that is made, when agreements are made, those situations are unlikely to be dramatically different from what they are right now. Yeah, there will be some pockets where some disruption will happen, but by and large, things will be closer to what we are seeing today and not have a dramatic shift is what is our understanding and our reading, but we do not.
Just to add here, we had also written about where this could take the US economy. Like Manoj said, tariffs will definitely increase the cost structure in US. Inflation is likely to go up. And the latest GDP forecast, talks about a significantly lower US GDP growth. So 2025, they're expecting GDP growth to be around 1.7%, whereas in 2024, it was 2.8%. And inflation trends are likely to go up. If you look at the US stock market, the FedEx is a very good barometer of how the broader economic activity works in the US. FedEx stock was down 10% on Friday. And that's a portender of what might happen in terms of investor sentiment. There are surveys, there's a survey that Bank of America ran, and they found that US fund managers are reducing their exposure to US markets by record numbers. So they're apparently underweight by 23% in US. And so they might be looking for bargains in China, Eurozone, and India. And therefore, the whole FII flows that we talked about earlier, we could see a potential return to India, and that could buoy the markets in India because liquidity is going to go up. So see, Trump का जो है, it is कहीं पे निगाहें कहीं पे निशाना भी हो सकता है. Like the attempt is to make America great again, increase traffics, but the other consequential effect is growth of US economy, US manufacturing specifically, where a large section of the US establishment feels that they have hollowed out a lot and lost competitive advantage. There's a lot of dependency on China, and so that's another factor. The whole focus on immigrants, reducing immigrants, also could increase costs. So inflation in US could go up in the short term. Subsequently, it could ease, but meanwhile, the US markets could get impacted. That could have another impact. So there are a lot of cross flows here that we are looking at. And so we'll come back to it when Manoj talks about the Indian markets and our portfolio.
So that is why we are saying that whatever Trump is doing will not necessarily benefit America, and therefore there will be some backtracking. as you know, mm, governments try to balance, negotiate, cut deals, etc., we will not see a huge shift away from uh, what is there. But if Trump wants to have his way, then there can be a huge implication for the US, is what Ram was trying to say. So, so impact of this on liquidity. Now, if the markets in US are going to be volatile, there is going to be uncertainty there, and there are a lot of negative parameters, then again, this money will try to find its way to markets where there is greater prospect of return. So you, as Ram mentioned, you can probably over a 3, 4, 5 month period, we can start seeing FII money coming back to India as well as to other emerging markets. Now, there's one thing that I thought we will clarify or maybe share with all of you, because there's a lot of news that is coming that FIIs are taking money out of India, FIIs. Now, just to put things in perspective, FIIs taking money out of India is not a new phenomenon. It is actually the DFIs who hold the economy and the markets together. Since Jan 2014, I've chosen that period because we've had some significant changes in political landscape. So since Jan 2014, FIIs have been net sellers to the extent of 6 lakh crores, including the recent sell-offs. So in 8 out of 11 calendar years, FIIs have been net sellers. And despite that, the Nifty, of course, with all its up and down movement, has gone up from 6,200 levels in Jan 2014 to the current 23,200 odd, which we saw yesterday.
So I'm projecting that chart, Manoj, as we speak.
Yeah.
Yeah.
Okay. Now, the markets went up because the DFIs during the same period have pumped in 13.6 lakh crores. So as compared to 6 lakh odd crores being withdrawn from FIIs, 13.6 lakh crores have been pumped in. And therefore, money is continuing to come into Indian markets, and that is propelling the market up. Of course, there are various reasons, etc. But the point that I wanted to make here is that we are not that dependent on FIIs. FIIs will take money out, FIIs will come back. Okay. The DFIs have been consistent, and this has happened because people like you and me have kept faith in equities as an asset class. So even today, for the 11th month of current financial year, the amount invested through SIPs in equity mutual funds is 2.63 lakh crores. 6.4 crore new SIPs have got registered, as against 4.62 crores of discontinued SIPs. So that means new investor, despite all that is happening in the markets, people have faith in Indian markets and people are continuing to put in money. And if money continues to come in, then the markets will go up because this money has to be invested. This is not to discount the role of FIIs. If FIIs had not taken out this money, then the amount of liquidity in our markets would have been much higher, and probably the markets would have reached much higher levels. The idea of sharing this data is only to highlight the fact that our markets have been doing well despite FIIs exiting in large numbers. So all this talk of, FIIs will take away the money and then markets will fall, and more money will be taken out and there will be greater fall, etc. Yeah, that might happen, but that money again is going to come back. Maybe 20,000 crores a month or whatever. And then there will be a time when that money will get out in large numbers. Like the way it has been, itna paisa nikal liya, so many billion has been taken out. Yes, it has been taken out, but still the DFIs are continuing to put in money because you and I are continuing to put money in the market. So this kind of game will continue to be played. And therefore, my appeal is to not look too much into the FII money flow. Yeah, it is important. If FII money turns back, then markets are likely to go higher. All that is fine, but don't lose sleep over FII capital. FII capital will simply come in wherever there is prospect of greater return.
So
Now,
what we are doing is, if you look at this latest chart here, uh, the last two, I mean, we are seeing in the last few sessions, there is net FI money coming in. Again, this is a daily chart. Obviously, noise is higher. Monthly charts still show negative, but if this is a trend and if we correlate this with what is happening in the US, the potential concerns on recession, uh, immigration related costs going up, tariff related costs going up, then FIs and the recent survey by Bank of America, this could come back in a rush, and on a tactical basis, we could see a jump. But what we are doing is, whenever there is an advantage, we are taking advantage of these price movements. While we are focused on fundamentals, we have recently expanded our team also, and we are making sure that any investment opportunity on a tactical basis is also taken advantage of. Back to you, Manoj.
so I guess I've taken a lot of time, so probably I'll wind up soon. So the last point that I wanted to make was on the valuation front. Again, a lot of noise. India's equities are overvalued, etc. Yes, there are on some parameters. For example, the buffet indicator that which is your market cap to GDP ratio. Currently, it is at about 114, which is read as slightly overvalued. But the corresponding number for US is 189. Okay, so from that perspective, the US is far more overvalued. From our simple, the most commonly looked at metric, the P, Nifty P is currently at about 20.6, while median P is at 21.8, meaning Nifty is actually at a level, Nifty P is at a level lower than its median. So it is not that our markets are highly overvalued and are poised for correction. A lot of correction has already happened, and maybe there is likelihood of some more correction. Can't rule it out. We don't have a crystal ball, but valuations look far saner than what they were a couple of months ago. It is here that we need to probably look at China. Because going by these parameters, if we think that 20.6 is reasonable and 114 is okay, then China's P is at 9.97 and the Buffett indicator is 67.5. So China is clearly very attractively valued. So for money to flow in, obvious, and this is after all the gains that they have made. Of course, last 2-3 days again, there's been a bit of a up and down, but even after factoring in the recent increases, China still continues to be very, very attractive from a valuation perspective. Its growth rate is again not bad. I mean, we are at 6.2, we are fastest growing, etc. But China is at 4.6. So it's not that China, and given China's size, that is significant. Okay, China is at least 3 times more our economy. So a growth rate of 4.6% is significant. Coupled with this, the stimulus offered by the government and a lot of steps that are being taken, China will definitely be a big competitor for India insofar as foreign funds are concerned. Again, this will depend on how China negotiates the tariff terms. also the issue with China is that it is still led by investment and exports, whereas there's hardly any private consumption. And whatever stimulus the government is offering, it's not resulting in private consumption picking up. Contrast this to India. India's growth is primarily consumption led, and the recent budget and the monetary policy are actually trying to capitalize on this and provide more impetus to consumption led growth. Now, given all this, what do we conclude? One, as always, liquidity drives markets. Outflow of FII capital is hurting our markets, but DFIs remain bullish and continue to drive growth. FII money will come back, maybe again go and return. That in-out will happen. Whenever there is an inflow, markets will soar. When there is an outflow, markets will correct at a much slower rate. With Trump tantrums and with valuations of China being attractive, we are unlikely to see the return of FII money in a hurry. Markets are currently bouncing back, but we might see a retracement of these levels in the short term. The DFI support will ensure that we are not going to be tumbling down. In the next 6 months, a lot of uncertainty will pave way to greater understanding of future direction. Things should start looking up from there. India's consumption, supported by lower interest rates, should help us continue to be the fastest growing economy. Our fundamentals in terms of our macros are firmly in place. So it makes sense to remain invested in India from a long-term perspective. I think this completes my analysis of the situation. Over to you, Ram.
Yeah, thanks, Manoj. So, I think we are about 35 minutes into the call. So we will now look for any specific Q&A. If not, please feel free to enter the chat. We are kind of in a webinar mode, so chat is the best way to communicate. Um, uh, there were concerns around portfolio, some of the stocks being impacted, etc. See, we have looked at the impact of all these events on the portfolio. If I were to give one example, the one of our stocks that we had an exposure to the US agriculture market, and we noticed a potential for tariff related business degrowth there. So that's why we have called for an exit in PI Industries, which is one of the stocks in the portfolio. Yeah. In fact, a year and a half ago, there was a big concern on that stock about China entering that space and huge competition increasing, but we held on to the stock, and later the stock really recovered and did well. But now, given the overall scenario, we have exited PI Industries. In the managed portfolio model, the PMS, we are also tracking 3 stocks for closure as an exit. One of them is Natco Pharma, where there was a significant impact on the business growth because their cancer-related drug is going out of patent. And there was a drop in both the top line and bottom line of the company. And as soon as the results were out, the stock just tumbled like anything. So we didn't exit that in a knee-jerk reaction, but we are taking any advantage of the up moves in that price to exit that stock in the portfolio for PMS. For advisory clients, we are going to communicate to them about that as well. Another stock that I will cite as an example is KEI Industries, which is one of the leaders in the cable and wire segment industry-wise. And recently, that industry also has seen a huge spate of competition. The Birlas have entered, Ultratech Cement has entered that space, and now Adani's also have entered, and that announcement just came 2 days back. And Adani's, with their forward the backward integration that they have with their copper manufacturing capabilities poses a higher threat. So though we like the company results are good, etc. But given this, we don't the stock may stagnate for a next couple of years at least. And given that, we have exited partially for the PMS clients as well for that stock. So these are some tactical moves that we are taking, looking at how the events are unfolding, as well as how the um, uh, technicals in terms of how the market is moving on a. So if we have a long-term view that uh, this stock may not do well and we need to exit, we are timing that in the PMS model. So I think as I was speaking, I got a question from Raj on the Spark portfolio. Yeah, the Spark portfolio has corrected, as has the small and mid cap space. Um, uh, but having said that, I would still say that the Spark portfolio, since we launched it in June 2021, in the advisory model, if I were to take the model portfolio since then, it is still clocking around 24.6% CAGR. And that has outperformed, both the Nifty as well as the BSE small cap indices. And since we did the last rebalancing, which is just about 4 weeks ago, less than 4 weeks ago, the portfolio is up by nearly 5%, whereas the BSE small cap is up by 4.5% and Nifty 50 is up by 3.5%. So we did take specific calls. We have added one very good automobile ancillary manufacturer in that space, uh, given that Tesla is likely to come into India. And in fact, BYD, a large Chinese company, has committed $10 billion to be invested in their manufacturing facility in Hyderabad. So there's a lot of uptick that is likely to happen in the auto ancillary space. And we've added, you might have noticed, I don't want to name it on this call as such, some of these, because um, we don't believe in tom-tomming our picks, and later, if we don't communicate the exits, then some investor may suffer. So that's why we don't believe in tom-tomming the picks. But of course, that information is available in your portfolios, and I can easily answer that, or any of our relationship managers can answer that. But this stock we've added. Similarly, in the large cap space, we've added one very large leading financial services major who's doing really well. That stock also, we just added it in the last rebalancing. Yeah, so that's so rebalancing is happening on a regular basis, regular as in a quarterly basis. And in case of PMS, there are more event-based transactions that are happening in the overall rebalancing analysis that we do. Srinivas is asking a question. Maybe Manoj, you can take it. You mentioned consumption-based growth driven rather than FII-led growth. I don't think that's exactly what you said, but you can correct that. The entire world wants to take advantage of India's consumption, right? Not just India. For consumption to be sustained at economic levels, which sectors will be targeted in the short term?
Not sure I've understood the question correctly, but let me break this into 2-3 aspects that I covered. When I said consumption-led growth, that is our GDP growth. Okay, so typically there are 4 components of GDP. Private consumption, that is what you and I spend. Private investment, that is what we invest in our businesses. Government expenditure, that is what the government spends on both revenue as well as capex front. And then net exports and imports. These are the 4 components. When I said India's growth is in consumption-led, so we've seen over the last many decades that a large component, 60% plus of our GDP growth comes from consumption. Whereas that number is significantly lower in countries like China. So what our government has done is that it has given a further fillip to that, meaning putting more money in the hands of the public. Now, after I get the money, I may go and spend on buying a packet of noodles, or I can buy a color TV, or I can simply go and make the fixed deposit, or I can buy a financial services stock. I can do whatever with that money. Okay, so where the money will flow, when we say consumption-led stock, it does not necessarily mean that it will go into FMCG, etc. That is first part of what I wanted to clarify. Can I go back to the question? So FI-led, when I talked about FIIs, etc., that I am talking about stock market. Our stock market growth has been primarily because of domestic financial institutions. While FIIs do play an important role, but they are like, they come in, go out, come in, go out based on what they see elsewhere in the world. Whereas our domestic financial institutions have had faith in our markets, in our India story, and they have remained continuously invested. Now, when I say domestic financial institutions, again, it is people like you and me, because most of our mutual funds, let us say if I apply for a redemption, then there's no choice for the mutual fund. It will have to simply sell and give back the money. So we as investors have had faith in our markets, in our equities, and therefore the domestic financial institutions have been able to continuously invest. Now, what was the next part? So entire world wants to take advantage of India's consumption. Yes, that is right. And so not for consumption to be sustained at economic levels, which sectors will be targeted in the short term? This is the last part I did not understand, because when I say the consumption is being encouraged by way of putting money in the hands of the Indian taxpayer or Indian citizen, let us say. We don't even have to worry about tax. So there are people who will be spending. Now, where they will be spending, the government is not attempting to direct that spending in particular channels. Okay, that is at least that is not coming out explicitly. So I don't think that is happening. What the government is doing is, on one side, it is putting more money in the hands of people, and on the other side, it is giving a lot of incentives for our producers to compete in the market, both domestically as well as globally. And therefore, the guys who win the consumers will probably get the money into their business. I don't know if I've actually answered it correctly, but to the best of my understanding, I've done that.
You more or less covered all the key points that Srinivas had. You can also see the chart, Manoj, now, but Sanjay Chakrabarti's questions on FI and tariff decisions and reshuffling of portfolio based on strong macros, companies with more domestic and maximum export revenue front.
No, that is what I'm saying. We see, yes, as analysts, let me assure you, we look into all this. Okay, so we do, but end of the day, there are only two things: top line and bottom line. Okay, there has to be, we have to see the cash coming into the business, add to the top line, that is, company needs to earn, and then company needs to spend wisely so that it makes a profit. So the macro FIIs, DFI, they are investors. A person who is investing will look at it differently, and what will work in the economy, which company will benefit, etc. Yes, I take your point in spirit. What you are saying is, okay, given this scenario, should we look at our investments from that perspective? So let me assure you that we are doing that. Okay, so when we analyze the company, after all the AI is done, when the human intelligence comes into play, we do take into account all these aspects. So that is taken care of.
Okay. Nag Vasireddy's question on are Indian investors allowed to invest in overseas markets, for example, Chinese stocks? Let me answer that question. Yes, Indian investors can use an international brokerage firm like Interactive Brokers to invest, and RBI has the LRS scheme where you can remit up to 250,000 US dollars and invest in that, which is around 1.25 crores per annum. There are also some mutual funds which have exposures to specific markets. There is also an AIF that we have shortlisted, which recently closed actually. But there could be, I mean, we found after a lot of analysis one such fund, but there could be another fund um, uh, which uh, which takes exposure to specific global markets on the basis of a thesis that US is expensive or expensive market. If you invest, your 10-year returns will not be great. Invest in a cheaper market, 10-year returns will be great. Having said that, China has its own, whatever numbers Manoj said earlier, China PE, etc. Those may seem attractive, but China has its own long-term issues and risks associated with so many things. The whole geopolitics, the way this is playing out, um, and especially the closure of the Ukraine war, uh, means that the US establishment and deep state wants to definitely go after China over the next, medium term, not short term. So China is not sitting back. China is also trying to become the world's number one superpower. So there will be every 90 years. There's a theory that there's going to be a clash. Ray Dalio himself has talked a lot about that. Um, so coming back to the point, yes, Indian investors can invest in US and China and other markets. And we believe US markets today are expensive. Um, the correction in US that has happened so far this year, 7%. If you look at sector-wise breakup, 7% has been the fall in tech stocks. If you take S&P 500, around 12% is the correction that has happened in the consumer stocks, and all other sectors are positive still. So if the US goes through a big hit, this tech stocks may further fall. And it's very interesting because when I was analyzing other smaller uh, deep tech companies like a MongoDB or UiPath, etc., their stock prices have fallen 50 to 70%. And the big ones have fallen only 15, 20%. Tesla has fallen around 50%. uh, and uh, so if there is going to be a major US recession, and going by the Buffett indicator of 189, etc., of US, and the US PE ratio being in the high 30s still, and US price to book ratio being closer to 5, uh, there could be a significant impact. I mean, that's why we are wary about US impact, and many of the smart investors in the US are actually taking out money out of US now. So there's a lot of chaos that's going to happen in the world, but finally, sab ghum fir ke, it comes to, uh, India is a great place. We are not talking about it purely from a nationalist spirit, though we are nationalists, or at least I am one. But if you like pure economics of it, India has so much of underdevelopment, so much of opportunity, and China has its own geopolitical long-term issues. So these investors are bound to come to India. And like Manoj said, 8 out of 11 years they've taken out money. So maybe this is the time when they will actually push money big time. And if imagine what will happen if Tesla opens a large facility in India, uh, you know, that could uh, follow through with a lot of other companies coming in. So I think I'll move to the next question. Raj is asking, would there be an exit call via rebalancing for NATCO stock shortly after shortly for the advisory clients? Yes, of course, Raj. The selling that happened on NATCO was on um, significant volumes, and the stock has seen a significant support of late, uh, after falling to a record low of about 800, uh, uh, 870 rupees, 770 rupees. It's now at around 830. So we're looking at a good consolidation zone, and then we'll call for we'll take a suitable call at that time. So far, we have not exited even NATCO for our PMS clients, but when we do, we will inform the advisory clients also of the exit. So please be rest assured that we have not exited NATCO in the PMS. And when we do, we will inform all the key clients as well about that. But of course, there will be a lag, and there will be lag as in there could be a lag in your execution because you may be busy during the day, etc., etc. But we will do our best to keep you communicated. Um, Let's go to the next question. Nag's second part of the question was whether Maxium plans to invest in overseas market also. As of now, we are not having any immediate plans, but the AI system algorithm, whatever Manoj briefly incidentally referred to, uh, that can easily understand how the other markets also. So, by end of this year, we hope to have a clear algorithm, a data science led strategy that analyzes specific stocks. And hopefully, US being a large market, and US, if it undergoes a good correction, that could be a good point to enter, with those, armed with those insights. Um, but there are some of our clients who have taken up the AIF route also, for the global portfolio. But given the very large ticket size, we've been very selective about approaching that to some of the clients, and also the risk. We want that to be a small part of their overall allocation. Arjun has a question, sector specific. Tesla and BYD hovering over the Indian markets. Do you think it would impact our local manufacturers, Tata Mahindra, as they are also in an expansion mode? So, see, my take, I'll answer this, and maybe Manoj, you can add. The uh, fact that these guys are coming in, if you look at Tesla, especially, Tesla will play in the premium sedan plus space, and they will definitely take a good market share in that. But this market is also going to grow big time. If you look at the number of Indian consumers that are going to come in, I mean, there's another study, I forget the numbers, but by 2030, the disposable income in India is going to be so high that these sectors are going to grow big time. And I think Mahindra is already has built great technology on the in the EV space, and they have a great car in the 15-16 lakh segment. And there is a lot of potential even below that. Tata Motors is also doing extremely well with models like Punch, etc. Tiago being fully EV enabled, which are around the sub 10 lakh space also. So that space is where there'll be a lot of volume, and they will do well. And see, more competition, the better. BYD and Tesla, etc., when they come, they will also have a lot of volume for exports out of their base. So overall, I think the uh, uh, the auto space is likely to become stronger and grow overall, with this competition coming in. And technology osmosis is likely to happen. As it is, I think Mahindra's XUV 700 model has been pretty good, and it's been a runaway success. So I don't think we should doubt the technological prowess and capability of these companies, especially Mahindra. Uh, uh, Tata Motors stock specifically has fallen quite significantly, but at the current level, it is pretty attractive. We're monitoring that, though our preference is to have companies with nearly zero debt. And Tata Motors, unfortunately, doesn't have that. They have a lot of debt. So that's one reason why we've stayed away from that stock. But at current levels, it's a decent, I would not sell off that stock if it's already in the portfolio. Um, I hope I've answered Arjun's question. Um, Prashant is saying that one of his clients could not join but wanted to ask, why is the rebalancing not done once in a quarter only? Why not as and when approaches? Yeah, I think, I know the client who's answered the question. He was chairman of a PSU. Uh, and so I'm going to write to him also on this. The answer is that in PMS, yes, we are going to exit or enter stocks based on the tactical movement, price movements. So we'll definitely do that. In advisory model, we will try our best to keep clients up to date with the developments that are happening. But any client who's eligible to move into PMS, it will be easier in that for them and for us also. So that's a separate conversation that I'll have with. And I think I've already given examples of specific interventions we've taken about 20 minutes back in this call on some interventions that we've taken, which are based on opportunities that have arisen. So Raj says, good update, Manoj and Ram. Thank you for having these meetings. Any other questions? So one other point that I wanted to also highlight is that there are about 11 stocks in our Spark portfolio which are significantly into exports. So exports is an area where see, tariffs are going to hit every country. If US imposes tariffs, the primarily US, Canada, Mexico, and China are being targeted, and of course, India also has to uh, uh, respond to their assertions that our tariffs are high. But when the tariffs are going to hit the other countries, it could be an opportunity for some of our companies also to become stronger. Um, Industrialists tend to prefer high tariffs for their own personal or vested interests. And I believe that the textile industry is one industry where such an attitude has really impacted India. We had a great opportunity with garment exports, which we unfortunately lost out to Bangladesh. And I was hoping that we really do well. Unfortunately, though the textile minister about 3 4 years back made a very huge statement that we'll grow it industry 10 times, etc. But actual ground may, we have not seen too much of that. And even the last year's Bangladesh political coup that happened, there was a lot of uncertainty. We could have really taken away business from Bangladesh, but maybe our industrialists in that space are smug and they have not really moved fast. Let's hope that they take advantage of this and do something in the textile space. Okay, we'll wait for one or two more questions and then we can wind it up. While we wait, one observation I want to make is that markets will have ups and downs. So the month of January was painful for many of us, but if I look at our model jewel portfolio, since rebalancing, it is up by around 6%. Um, and so there will be ups and downs. So let's be patient with these stocks. These stocks, we are not promising very high returns to our clients, but what we are promising is that we will invest in high quality companies with low debt, good management, consistent growth in top line, bottom line, so that we can be assured that our money is invested safely and in the right pockets, and we can sleep peacefully. So that's our, I think, main value system. We are not chasing returns as such. Returns will be a byproduct of this. And we have all the data to show how the portfolios have performed over the last 5 years, 6 years in case of Jewel, and nearly 4 years in case of Spark. And every stock that is there has been selected carefully based on that. And we've learned a lot along the way. We have been a bit more cautious in the last 2 years about not picking stocks that are highly valued. There are so many good stocks that we would have picked, but we found that the prices already multiplied 50%, 60% in the run up. And such stocks, have very little margin for safety. And that's proved in the month of Jan, Feb, etc., when some of the stocks, also fell significantly. So, um, uh, so that's the whole thing about our investment philosophy. I think with that, we'll close the call. If there's anything else, I'll get back to people on a one-on-one basis. So thank you for your time, everyone. And with that, we'll take leave. And wishing you all a happy Ugadi and a happy Sri Ram Navami ahead in the next few days. Thank you. Bye.